Good afternoon. This is Jim Stewart, the Chief Investment Officer at Worth Asset Management, and this is your mid-February update. I'm going to go over 3 charts, 3 performance metrics, and 3 key takeaways in under 3 minutes. All right, let's take a look at this chart. Number 1, AI disruption rattles the tech and large cap markets. If you look over here, you're seeing the S&P 500, and basically it's flat year to date. The NASDAQ is down 3%, and the Dow Jones, which doesn't have a lot of tech, is actually up 3%. Number 2, metals and commodities continue to shine. If you look, yes, gold and silver have had some volatility lately, but if you look at the year-to-date performance numbers, you can see that it's up 16% year-to-date. Oil, on the other hand, also is climbing, and a lot of that has to do with the U.S.-Iran tension. But if you look over in this other column, which looks at a 3-month performance view of the sectors, you see that the market is rotating. It is moving away from the financials and the tech into areas that are more interest rate sensitive and defensive, like staples, like materials, like energy, including international and small cap, which is a good thing. All right, let's take a look at our first chart, our key data point number 1, which is the CPI, or Consumer Price Index. Number 1, year over year, it slowed from 2.7 down to 2.4. And even though we had a government shutdown and didn't get key data point after the CPI was starting to trend upward, it is now starting to keep that trend downward intact. That, plus the flat retail sales data, supports the Federal Reserve's prospects of cutting interest rates 1, 2, or even 3 times. And let's take a look at those graphs. Here's the last graph here. And yes, rates are anticipated to drop this summer, but not in their March meeting. 96% says that there will not be an interest rate cut, but let's take a look at June. We are now up to a 50-50 chance that we will get 1 or 2 rate cuts in June, and by July, there's a 71% chance we get 1, 2, or even 3 rate cuts. I'm leaning towards 1, maybe 2 if things start to deteriorate or if the market starts to take off. All right, what are the 3 key takeaways from mid-February? 1, volatility is back. The VIX settled at over 20 on Friday, and when it gets over 20, that's basically a yellow light saying, hey, keep an eye on this. You're going to see some big moves in the market up and also down. Number 2, the S&P 500 is in a very narrow trading range. The large caps are kind of bouncing back between 6,800 and 7,000. We need to break out of that range in order for them to continue to trade higher. But if we look underneath the surface, as I was explaining earlier, we're starting to see a rotation and a broadening out. And the S&P Equal Weight Index, which equally weights all of the 500, it's actually up 6%, which means that those large, big companies that usually dominate the index are not doing very well, and everything underneath it is. This is very healthy, and this is great for this market to continue this rally. So we shall see, but if that continues, we will continue to trend higher. That's it for this week. Thank you for joining us. We'll see you next time.